Markets are sitting near all-time highs, but some macro strategists think we are closer to a turning point than most people realize. In this video, we're breaking down a bold market call that includes a potential melt-up first, then a major downturn later. Simple language, clear risks, no hype. Our source for today is David Hunter, Chief Macro Strategist at Contrarian Macro Advisors. He's known for taking the opposite side of consensus views, especially when sentiment and positioning look one-sided. You don't have to agree with him, but his framework is worth understanding because it forces you to think in scenarios, not headlines. Hunter's core view is extreme and very specific. He believes the stock market could make a powerful run higher in the near term, what he calls the final leg of a decades-long bull market. Then he expects a sharp reversal, with 2026 potentially turning into what he calls a global bust. In his definition, a bust is worse than a normal recession, but not as long as a depression, and it comes with a financial crisis vibe similar to 2008, possibly larger. This part confuses a lot of people. Why would stocks rally if the economy is weakening? His explanation has three drivers. First, sentiment. He argues institutions have stayed cautious for years, even as markets climbed. If big money shifts from cautious to fully invested, that chase can create a fast move higher. Second, rates. He expects bond yields to fall, which can lift equity valuations and make risk assets look more attractive relative to cash. Third, Fed easing and liquidity. When the market believes the Fed is cutting and conditions will get easier, it can bid up stocks even if the real economy is not healthy yet. It can feel like an early cycle rally, except this time it would be happening near record highs. He also expects the rally to broaden, not stay stuck in the same mega cap leaders. He points to smaller caps as potential late cycle participants. In other words, he thinks the market could look strong and healthy right into the top, which is exactly what makes a final leg so dangerous because it feels convincing. Now, the downside. Hunter's big concern is leverage. He argues global debt and financial leverage are much higher than in 2008, and leverage always works in both directions. It amplifies gains on the way up and accelerates damage on the way down. He highlights several areas where stress could show up: commercial real estate, private credit, leveraged corporate structures, and banking fragility outside the United States. His point is not that one sector alone causes the crisis, but that a shock can travel through counterparties in ways that are hard to see in real time. Another key idea is policy hesitation. He believes central banks and governments may be reluctant to respond quickly because of political division and the lingering backlash from previous bailouts. Even if they eventually act, he thinks a delay of weeks or months during a rapid deleveraging can turn a bad situation into a crisis. He's basically saying the market can fall faster than policy can react, and if confidence breaks, it becomes self-reinforcing. Hunter frames the bust as deflationary first. In that kind of shock, investors often run towards safety, and government bonds can rally even when everything else is falling. He even suggests the possibility of extremely low long-term yields during the worst part of the downturn, because the priority becomes stabilizing the system, not fighting inflation. Again, you don't have to accept the exact numbers. The educational point is the sequencing. In a deleveraging, cash and safety can dominate temporarily, even if the long-term outlook is inflationary. Then he shifts to what happens after policymakers step in. His thesis is that the recovery that follows would look different from the last few decades. Instead of disinflation and cheap globalization, he expects more reshoring, more industrial build-out, and more commodity demand, which could create an inflationary cycle with different market leadership. He also makes a practical observation about passive index investing. Indexes are heavily weighted toward the winners of the last cycle. If leadership rotates, passive exposure may lag the new winners for a long time. To his credit, he also admits uncertainty. A milder recession instead of a bust, less systemic banking stress, stronger policy coordination, or stronger growth outcomes could all change the path. The takeaway is understand how leverage, liquidity, and policy response shape market outcomes. Want to know how we trade this major technology trend? At Truthsayer AI, we trade every single one of the alerts our AI generates. If you are interested, you can join the thousands of clients already on our app who are taking advantage of these trades every day. Remember, we trade every one of our alerts, our machine learning and AI models generate. Sign up on our website. You won't regret it. Thank you for watching and don't forget to like and subscribe.